Hey everybody, welcome to another episode of Note Investing 101. Kind of a little mini series that we've put together to kind of, I don't know, I feel like it's like giving away secrets or pulling back a curtain or something. I don't know. I just picture this like whole like magician thing or whatever. But anyway, I'm Fred Rui.
I'm Tracy Z.
Tracy Z, and welcome. This episode, what we're going to concentrate on is profiting from notes, aka show me the money.
That's the best part of the industry. You get to help people and make a profit at the same time. So we've been doing this, as we mentioned in the last episode, for a combined 50 years. I started in 1988. Fred, you were in early 90s. And we met along the way. And we had a few people ask this from the last one. Yeah, we are business partners and we're also life partners because we're married. We have a daughter who's grown and also works for us. So we're really excited to share with you some different strategies on profiting with notes. And we've got some slides. Shall we just head over to them, or how do you want to do this?
Yeah, so just real quick before we jump over to the slides.
The good stuff, yeah.
Well, I don't know what the good stuff is. Now I feel pressure to have good stuff all of a sudden. So actually what we're going to do today is we're going to cover 4 deals. We're going to give you 4 different examples. We're going to jump into slides. But what's different for other videos we've done, this is live. So if you're watching right now, either on Facebook or YouTube, we have a secret person behind the scenes that's really running everything for us. So we can actually just concentrate on educating and not do the technical stuff, despite 10 lights around us and 3 monitors and an iPad and everything else. But anyway, I digress. You can ask questions. So if you're watching this live, you can type questions in there. If not, you can say, hey, hi, Fred, we're in Montana, wherever we are. And that's it. So we're going to jump into a screen. And this should only be about 30 minutes. So hopefully you brought a drink and some snacks or something like that. But we're going to go over profiting with notes. And we're going to go over 4 very common, I guess, deep dive into numbers a little bit.
Yeah, I love the numbers. And as you say, you don't like math, but you like money.
Exactly.
So
I wasn't good at math.
We promised that we have something in here for everybody. So we try to make it all very digestible because the note business can be as simple or as hard as you want to make it. And so we start out with the very basics, right? So how do we profit with notes? So those 4 profit strategies that Fred mentioned is the first one's flipping notes.
Yeah, so flipping notes is basically, here's how you look. There's 2 ways you would flip a note. One is you don't have your own money to buy the note. So maybe it's too big of a note, or you just don't have
your funds are tied up.
You're just starting out. Yeah, your funds are tied up, or you're just starting out. The second is that maybe you're buying notes with your own money, like out of your retirement account or whatever, but it's a note that you don't want to personally hold, but it came across your desk. So you know what? We might as well flip it onto somebody that is interested in that and make some sort of money on it.
Yep. So that's flipping with note. It's great for immediate income now. And then we're going to talk about number 2, purchasing notes. So flipping notes or wholesaling notes is great for making fee or immediate income, but purchasing notes is how you generate a portfolio for long-term passive income. That's how you get the interest income. That's how you get to step in the role of a bank. And so a mini bank, right? A private bank. So we'll talk about the benefits of purchasing notes and how that works.
So the third one is a partial participation. And if you've heard us talk about partials, and our eyes kind of light up, it's like the coolest win-win for everybody. It's a way that you can minimize your risk. It's a way that you can get more money to the seller. It's a way that you can increase your returns. So we're going to do an example of that. And this is a really, really powerful strategy.
And then the 4th thing we're going to talk about is creating notes. So you might want to use seller financing to buy property, to sell property and create a note. So we'll have an example that combines a couple of different strategies at the end there on number 4 for creating notes. So without further ado,
ta-da, let's do it. So the first one's flipping notes.
Yeah. So this was some property that was acreage in Tampa, Florida. And it had sold for $237,640. It had a nice down payment of $98,640. And so the seller carried back a balance of $139,000. So that's called the original note amount, the original balance. That would have been the unpaid principal balance, the note balance at the time this note was created. And it was written at 6.5%. So if I was writing a land note, I would have made it higher interest rate. But when we were approached with this note, they'd already sold, they'd already created it. And this was what we were presented. And the payments were $878.58 a month. And it was all due in 5 years. So it had monthly payments, but those monthly payments wouldn't have paid it off in 5 years. So there's something called a balloon. Now, not a lot of notes have balloons, but some notes do. And so if they do, it just means there's going to be a big payment at the end that the monthly payments don't pay it off. A normal deal, monthly payments pay it off. So this is how it was when it came to us.
Yeah. So when we saw the note, it's a balance of 138,000 and only one payment had been made so far. So for us personally, when we're looking at where to put our money, and everybody's a little bit different and everybody has little hot buttons, we certainly could make an offer on this to keep for ourselves. It's a really good down payment. Like Tracy said, I'd like to see a higher interest rate. For us personally, a balloon due in 5 years on just, on raw land, if you will, is a pretty big size note to not have a single family residence on. So this is one that we're actually going to, and also no seasoning being that they've only lived in it, or not lived in it, but they've only made one payment. Yeah. So this is one we're going to look at flipping. So what we're going to get is see, well, how much would an investor pay? And, if you remember the last episode, we talked about, we find out from an investor, how much are they willing to pay for this note? And the investor basically came back and said, look, I will buy this note with the balance of $138,874. I will pay $120,000, $120,141.27 for this note. Now we have to subtract something for ourselves. So we take off about $5,000 and we offer the seller $115,141.27 for their note.
And we actually do always quote to the penny. You want to talk a little bit why that strategy is?
Yeah, so I'm really big about not creating what I call, and I've done videos on this called newspaper negotiation, where, if I offer the seller in this case, and let's just use these numbers. So, we know the investor is going to pay 120. I know I'm going to offer something less than that. If I offer the seller an even 115,000 for their note, they're likely to counter back with, well, okay, I want 120. Or if I say 116, then they say 119. And we go back and forth, kind of like when you're negotiating and buying something out of a newspaper or a Craigslist ad or something like that. So I always find that the two key things I try to do when I'm making an offer on a note is, one, establish this is the fair market value of your note. This is what your note is worth. And I have found by putting a penny on it, literally going all the way down to the penny, making the seller an offer, in this case, of $115,141.27. When you're looking at it as a seller, and you don't know the math behind it in the calculator, but you're looking at it, you're thinking, wow, this is a very precise offer. There has to be math involved behind the scenes, and there is. But there has to be some sort of, this must be down to the penny what it's worth. So people aren't going to counter and go, well, what about 118, 243.95? I mean, so they don't typically come back with that. So I will always make an offer down to the penny, and you'd be surprised how much it makes a difference.
Yeah, so you can tell usually Fred's offers because they ended 23 and mine usually ended 27.
Yeah.
So this is one that we received. We got the quote from the note funder. We took off the $5,000 we wanted to make. We offered it to the seller. They accepted it. So at closing, we made a $5,000 referral fee. And so that's flipping a note. Some people call it wholesaling a note. Some people call it brokering a note. We tend to stay away from the brokering term because people get confused and think you're brokering something else. So we usually call it flipping or wholesaling a note.
So one thing I want to point out before we move on, because we're going to get to partials here in a minute, is, and this came up in our last episode too, where people talk about the discount. So the discount the person is selling $138,000 balance for $115,000. That is the note discount. Yeah. Now, if they could have sold it for all cash back then, they may have accepted that discount. They may have sold the property for a lower price if someone was a cash buyer. What typically has happened in a situation like this is something's happened. This person needs $115,000 or $100,000 to go invest in another property and move on. So that's why they're willing to take that discount. But hold on to that thought, because you're seeing $138,000 go down to $115,000, which that just depends on why they're selling. But you're going to see a better way to handle this pretty soon.
Exactly. All right, so this next example is going to be purchasing a note. So we're still talking about a full purchase. And this one, you want to start us off on this one?
Yeah, so this is a mobile home. It's a 1983 double-wide mobile home on a lot in Florida. And the original sales price was only $20,000. Yeah, it's $20,000 with a down payment of $2,000. So the original balance of the note was $18,000. Now, when they write up the note at the $18,000, they did it at 8%, which is a pretty decent interest rate for 5 years. So it's not a very overly long term, and it's $364.98 per month.
Yeah, so sometimes when we're doing these examples, we like to show some smaller deals. So what works on a $100,000 note or $20,000 note works on a $250,000 note or $500,000 note. But for a lot of people getting started, I think, especially if they're looking at purchasing a note for their own investment, sometimes they like to see the realistic numbers that are within their achievement. And if you've got a larger investment portfolio, then you can just add a couple of zeros, right?
Yeah. So this is a great example of if you have a self-directed IRA where you can actually put your money into a retirement account that you can decide what to purchase in a lot of cases, and notes being one of them. So this would be if you have a smaller IRA. Small balance IRA. Yeah.
So this is what we did with this one. At the time it came to us, 14 payments had already been made. So it had a nice amount of seasoning, as we call it. 14 payments, that'd be a year and 2 months. The balance had paid down, so it's paying down quickly, like Fred said, because it was only a 60-month amortization, paid down to $14,417.63. So there were 46 monthly payments left of $364.98. No balloon. It really paid off in that amount of time. So in this situation, what we've got is we offered to make a full purchase of all 46 payments for $8,650 because it's a lower, older mobile home. And so the seller accepted, and this went into our IRA. And this was a yield to the IRA of about 39%. So that's a great return. Remember, yield is IRR, internal rate of return, a little bit different than ROI. But if you use a time value of money calculation like we do and like we teach, which is the standard calculations, you don't have to be afraid of it. There's a nice software program that runs that. That's a great return on investment to your IRA.
Yeah. And just so everybody understands, we didn't change the interest rate of the person that's making the payments. What we're doing is we're buying an existing cash flow, in this case of 46 payments of $364.98, but we're paying less than the current balance. And for every dollar we pay less than the current balance, our yield, our return goes up. So in this case, if we pay $8,650 for this, we get a 39% return.
Yep. So the payer, the buyer, the person buying it, making those payments, they still pay the 8%. Like Fred says, their terms never change because those are set in stone by the promissory note. Yep. But what we can do is pay less than the unpaid principal balance. And by doing so, the yield goes up. So now we get to talk about the fun one, right?
Yeah, this is a partial.
Yeah, we really like this. So the partial participation, one way to participate in partials is to buy all the payments and then sell some of the payments and keep something in the future. So we call it a buy full, sell short. So this is how it works. You've got a full purchase from the note seller. We just kind of want to set the stage before you get into the numbers. So you buy all the remaining payments from the note seller, and then you sell some of the payments to an investor, like an institutional investor. And you can either buy it and sell it, or you can do a double closing where the investor funds the seller. And then you, the note pro, get to retain the payments off into the future after those first few payments are received by the investor.
So let me do a weird analogy here, just so that everybody gets in bogged down.
Have I heard this one before?
No, you have not. I'm going to make it up right now.
We never know what's going to happen.
So this is the way it looks. So because it gets, buy full, sell short, all that stuff. Let me just say this. If I buy a Snickers bar for $1 and I break it in half and I sell Tracy half of it for $1, then she just paid for my Snickers bar and I got half a Snickers bar free, right? I paid $1 for a whole Snickers bar, broke it in half, gave her half of it, charged her $1 for it.
You didn't give it to you, you charged me $1.
I charged you $1, but now my half is free. That's what we're about to do with the note.
That's a very good analogy.
I just made it up.
Yeah, that's good.
Mostly because I really wanted the Snickers bar.
Yeah, great. Now we're hungry. That's great. So that's what we're going to do with this deal.
Yep. So this property is a commercial and this is a church, believe it or not. So this is not something we were necessarily wanting to own outright ourselves for a whole lot of reasons that are.
Who wants to foreclose on a church someday?
I mean, just,
not that you thought you'd have to, but you wouldn't want to.
No. So the sale price was $135,000. You want to start this one off?
Sure. It was $135,000. And it was actually like a retail building that was being used as a church. And they put a $10,000 down payment, and the balance, the seller finance balance, was $125,000. And they paid, this had a good interest rate.
It did.
Somebody knew what they were doing on the interest rate. So the buyer was paying on the note 10% interest rate, payable in 360 payments. So it was written at 30 years, what you more traditionally see, right? At $1,096.96. So every month the buyer spent $1,096.96 to the seller, and they were going to do that for 30 years. And when we were approached with the payments or to buy this note, it looked like this.
Yeah, so there were 54 months have already been made. The remaining balance was 121. So you can see at 10% interest, it doesn't go down very fast. They've been making payments for 54 months and it only went from 125 down to 121. So there were 306 months remaining.
Yeah, so this is how it looked when it came to us. There were 306, meaning that's the whole Snickers bar in Fred's analogy. The whole Snickers bar is 306 payments.
Yep.
So this is what we negotiated. The seller sold all 306 payments for $92,804. That's what we negotiated for them to receive. And we had an investor that was willing to buy just 186 payments, so half the Snickers bar, for the purchase price of $95,046. So they actually paid more for the 186 payments than we negotiated to buy all 306 for.
Yeah, and the reason being, by the way, is that, due to time value money, those payments way out there aren't worth as much. That's partially, it's not dollar for dollar, it doesn't stay equal. So as the payments get farther and farther away, they become worth less in today's dollars. So that's why we're able to sell the next 186 for $95,000, but buy all 306 for less than that.
So what we did was, first of all, we made a fee at closing. So we have a certain amount of costs and overheads. And so we made a fee of $2,242 at closing, less some expenses, because we did have to pay for a BPO and a title on this one for this particular investor. So we made the difference between the two at closing. But what did we do? This is the really cool special part. This is the reveal. Not only did we make some money at closing, we kept 120 payments, 10 years of payments of $1,096.96. So we bought a full, we sold a partial, we made some money on that, and we retained the future rights to pay 10 years of payments down the road. So that investor got the first 186 payments, approximately 15 and a half years, and then we got the last 10 years of payments. But that's a really cool thing, right? I mean, that's the beauty of partials. Now, it can be split up in different numbers. There's no limitation to that. It really just depends on the note and the term and what the investor will invest. But this is the beauty of buying the whole Snickers bar and selling off part of it for the same amount of money and keeping some on the end. So when you buy full and you sell short, this is how the documents look. You've got the note holder, the seller, that sells it to the note pro with an assignment and a note endorsement and a full purchase agreement. And then the second piece is,
this is where we sell, the note professional, we sell to the investor with a partial. So we're buying a full with a full purchase agreement, but we're selling a partial with a partial purchase agreement.
And that investor on those partials will want a full assignment and endorsement typically, because they don't want to split up the note ownership. They want to have control. And so your right to the future payments is in the future. And then when that investor's made whole on their partial, then they will assign it back over and endorse it back over. So this is about the time people say, but what about if it quits paying, or what if it pays off early? And those are great questions. Yeah, one of the two, right? Yep. Usually, sometimes they just pay along exactly the way they are supposed to. But sometimes they stop making payments. So in that situation, that will be dictated by that purchase agreement. And it normally says that investor that bought those first 186 payments in this example, they're kind of like a first lien holder. So they have the first right to go in and collect what they're due. And then if there's something left over in the event of foreclosure, then us on the end would receive that. So because of that, you don't want to stake a whole bunch of dollars invested on the tail end of a partial. You really want to turn some of your profit into that. In our opinion, that's normally how we like to structure those. So the partial agreement outlines that. The other thing that happens hopefully more often and usually than our experience is that it pays off early. The buyer decides to sell it and they pay it off, or they're able to refinance and pay it off. And that's what happened on this deal.
Yeah, in this particular case, it was an early payoff. So they paid for a period of time and then they actually paid off early. So the numbers on this is that basically 12 years went by on the church note. They were making the payments according to plan. And then they decided to pay off the note. Now, at the time when they went to pay off the note, the full balance they owed was $96,915. But remember, we broke apart that Snickers bar. So there's a percentage of that is owed to the person that bought the first set of payments. And there's a percentage of that Snickers bar that we left on the table that we were going to get in the future, but it does have a value. So the partial balance paid off for $39,346.18. That was how much was left on their Snickers bar.
That's how much the investor received. So there's three balances going on here at any time, right? There's the full balance that the buyer owes. There's the partial balance that the investor is to receive. And then what's left over is on the end. And that's what we
So basically we're getting the today's value of what the back end of those payments would be. And that would be C, which is the remainder. And so we were the remainder, we were the tail end of that note, but we got a check for $57,569.28.
Yeah, and this came through the servicer. It was serviced through a third-party servicer. So when that buyer wanted their payoff statement, that servicer sent them the payoff statement for $96,915.46. That buyer sent in the payment to the servicing agent, and they collected it. They knew we had a partial tail end, so they got a payoff statement for the partial from the investor for $39,346.18. Sent them their check, and then they sent us the difference.
So without doing the payoff, somebody sent in the question, they want to know what's the return for their investor on their investment. Do you know what their return was in the very beginning? Not counting the payoff.
Not counting the payoff. I believe they wanted an 11% yield. We can back it up. But if I remember right, it was 11% yield. Now, whenever it pays off early, either for that investor or for us on the tail end, we actually, our yields all go up because we based our calculations on it going much further out into the future. And like Fred mentioned, payments now are worth more money. So when it pays off early and you've bought at a discount, your yield actually goes up, both for the investor and for us.
So the other question on this actually ends up being typically, that was a good question to ask what the investor yield is.
Yeah.
A lot of people ask, what's our yield? Well, here's where it gets a little strange. In order to have a return on your money, you had to put in money. So to tell the calculator, go, look, if I invest this, here's how much I'm getting back. Here's my return. Well, think about this deal. We got just over $2,000 up front, and we got held back in the notes, of which we ended up getting $57,000. There was no investment. So it's an error 5 in a lot of calculators because all we invested was our time.
Yeah, that's very true. And marketing dollars, I guess you could count that as an investment.
But it's really high, whatever it is.
Absolutely. So sometimes people say, well, I want to do this in my self-directed retirement account. And normally with a self-directed retirement account, they do suggest that you actually take the title and invest the money, then sell the partial. This one we did outside of a self-directed retirement account. We did it through our company. So it was just, it is ordinary income when that money comes in. But, having to pay Uncle Sam is not always a bad thing, right? Sometimes it's a good thing. Yeah. So do we want to run back and run that yield or?
I think it's close to 11. Yeah, we can run it, or you can email us what we can run it for sure.
Yeah, we do that example. We actually have a blog on our noteinvestor.com website that goes over the exact numbers along with the spreadsheets that show how the amortizations work. So if you went to noteinvestor.com and you clicked on our blog or our articles and you search church note, you would find that or partial early payoff. So we do a lot of, I love the number part. I really love understanding how compounding interest works. And that's why this works, is because of compounding interest.
Which reminds me, before I forget, if you want to see more of these videos or be notified of these videos, go to noteinvestor.com/101. Noteinvestor.com/101.
Look at just a
and you can assign, because we have people that are doing that.
I love that.
But now it's not as subtle because you pointed out. Yeah. Anyway, so if you go there, put your name and email in, and then you'll get notified when we do. Like I said, we're doing a set of these videos. We're doing a series of these videos on different subjects. We'll actually be doing one, which reminded me of it, is we're going to do a future one on retirement, self-directed retirements, and things that we do out of there. Absolutely. But we have one more of these to go through before we sign off.
So this is a strategy of creating notes, and it depends on the environment of the real estate market whether this works. And I see it working in different real estate markets. So it usually works when you're dealing with land, mobile home and land, or properties that are under $100,000 to $150,000. In my opinion, there's always opportunity to do this. When you're in a rockin' real estate market and interest rates are 2 or 3%, and there's not an incentive for the buyer to have owner financing, these don't always work. So not every deal is a seller financing deal. People ask me that all the time. I said, well, if every deal is a seller financing deal, there wouldn't only be about 6% on average that are seller financing, right? So this doesn't work for all deals, but when it does, it's a beautiful thing. So this combines a couple of strategies. We don't teach tax deed investing, but over the years, we've like all the kinds of different strategies. And so this was a property that our IRA picked up through a tax deed sale. And I believe it was in Arkansas. And so some states are tax lien, some are tax deeds, but we actually were able to pick this little house up for $710 at the county for a tax deed. So how do you take a little $710 property and turn it into a bigger profit?
Sell it.
Well, yeah, you can only sell it for so much, right? So in this kind of a price market, there would be tough to get any kind of bank financing on this property. So what we did was we advertised it for sale for 60 months, owner will finance, easy terms for $254.96.
So we're basically creating a note.
Yeah, we're going to create a note because the IRA owned it, or it could have been you personally, or it could have been your company, but you own this piece of property, and now you're going to maximize your profits by offering easy terms. So this is what it sold for. It sold for $14,000. The down payment was $2,000. So automatically, we already have covered our $710 purchase price plus some costs. Mm-hmm. And then we carried back $12,000, and the interest rate was 10%. So kind of a typical, small dollar deal, but a typical owner finance deal. So guess what that return was? If you put into your calculator $710 and then you get back $2,000, and then you also get 60 months at $254.96, it's a whopping 430% return.
Pretty good return.
It's not bad.
Yeah.
Now, are all deals like that? No. As a reminder of the disclaimer, results vary. There's always risk in investment. We're not attorneys or legal advisors. We always encourage you to do that. We're not offering to sell you a note or security, but these are on occasion the kinds of deals you see. Now, on average return we see is 7 to 10%. So these are not every deal is a home run, but there are deals that come along that you can have those kinds of home runs. Yeah. So this is the portion that we do a little Q&A. And so
we're going to get out of here. And I have a couple questions that I can see that have popped over to us. So one of the questions from Purnell is, so the $2K that you put in, where did you get that to use on this deal? Well, we actually didn't put in $2K. I'm trying to think, unless he's talking about a different deal.
Purnell, which deal are you talking about? The church note or that Arkansas tax deed? Let's see.
Well, it came in before that, so it has to be the church note. So that was how much we actually made up front. We took a little. We sold. We bought a full, sold a partial. We were able to sell the partial for a couple thousand more than we had to pay the seller. So that actually money went into our pocket on that.
Now, if you did need to put money in the deal, we didn't need to on that deal, but we have done other deals where we have put money in the deal. If you're doing it in your IRA, the money would come out of your IRA. If you were doing it in your company, the money would come out of your company. If you were doing it personally, the money would come out of your checking account. We do recommend, not giving legal advice, but we do recommend that you form some kind of business entity, because there's definitely some tax advantages to having an LLC or an S Corp or something like that, or doing it in a tax deferred or tax-free retirement account. But we do deals in our company. We do them in our IRA. We partner with other companies. So yeah, that Purnell was, we actually made $2,000 at closing. We didn't have to put that in. Yep. And then we made those payments on the back end as well.
Yep. Someone asked, is it a good idea to price a note only on the unpaid balance? We're going to have to do an episode on that because that gets a little confusing for everybody. Yeah.
Generally, yes.
Yes. Generally, you don't want to base it on anything. So it's usually whatever's lowest, either the balance or the value. If you're doing percentages of LTVs and ITVs based on that, you're going to go with lower. But yes, it's priced only on the unpaid balance. And just so everybody else follows along, is that you've got the unpaid balance, but then there's also what's the legal balance,
which is a non-performing note issue.
A non-performing, which we'll talk about in a different one. But yes, you would definitely go off that.
Yeah, so when we run our numbers for what we pay, we have this waterfall of what we do. So we say, okay, what is the amount we're investing compared to the property's value? That's the investment to value. What is the amount we're paying compared to the unpaid principal balance? That's the cents on the dollar. What is our yield for that cash flow? As what it pays according to the note? What is our return? And then we also look at what's our dollar discount, because as Fred talked about in the first episode, if you had a 10% note and you wanted 10%, you could theoretically pay 100 cents of the UPB, or the unpaid principal balance. But we want a discount because we have time and energy and overhead costs. And so that's kind of the main things that we look at when we decide what to pay on a note. And so that would be a great future episode as well, right? How to price notes.
Yeah, and Sarah asked the question, how do you determine the discount pricing? It's a great question. It varies. Typically, like we mentioned, I think in one of other episodes, is that you're talking somewhere between, what do you always say, between 3% and 5% or 3% and 6%. The discount.
Actually,
that was the fee.
How much
that was the
fee
fee
that people are.
Oh, okay.
The discounts all over the board.
Yeah, discounts all over the board. But I'll tell you this in a nutshell. Discount really is the difference between what they wrote the note at and what I want to get as a return. So if they wrote the note at 8. And I want a 10% return, then there's a certain discount in there. If I want an 11% return, the discount gets greater. If I want a 12% return, the discount gets greater. There are other factors that have to do with that. The discount could be due to how much equity is in the property or some other parameters, but the discount is largely determined by the calculator on there. Wouldn't you say?
Yeah, definitely. So yeah, the risk usually sets the investment to value and the yield requirement. And then when you apply that yield requirement to the cash flow, like Fred is talking about, that determines what the discount is. So there's kind of a 1, 2, 3, 4 step in pricing that comes up with that final number. And then when you take the balance minus the pay price, that is the dollar discount. But we try not to focus on the discount so much, especially with sellers. Well, and even if you're pricing a note, sometimes people say, oh, I like this big discount, but of course we do, but you don't want to get drunk on yield or drunk on discount. There's lots of good bread and butter deals that we've done where the discount might have only been $1,500.
Yeah.
So we're getting a 9 or 10% return on a really low loan to value. Maybe there are 40% loan to value. And that's a great little note for a retirement account.
Yeah, I mean, really, in a perfect world, I mean, everybody would go out and create notes at 12%, and then I would just buy them pretty much all close to par, and I'd get my 12% or whatever it is. So yeah, we're not always looking for that. Christopher said you bought for a 3.75 yield, then sold for 11.5 yield. You both earn more upon the payoff. Yeah, I mean, on early payoff, that works out really, really good.
Yeah.
Let's see what else here.
Christopher knows how to run a financial.
I know that was good on the fly. Where are the best places to find buyers and sellers of notes?
Oh, that's a great question, because that is going to be the topic of our next video. Is marketing for notes.
Oh, okay. So we're gonna do that.
Yeah. So we're gonna talk about marketing for notes. We're gonna take our 5 top preferences. We're
gonna take the 5 most common marketing methods. And we're going to grade them. We're going to tell you what they are. We're going to tell you, what we think about them. And we're going to give them an old school, like grade school grade of A, B, C.
We're going to get back the whiteboard.
Is there an E? There's not an E. No. A, B, C, F. Okay. All right. Yeah. Is there a D?
I don't.
There is a D.
There is a D.
Oh, shoot. See,
how long has it been since you've been in school?
A long time. That's not important. That's not important. So again, if you want to see more of these videos, and we like I said, we have a set of these that we decided to do. We don't have an exact number, but we basically wanted to take on a different subject on each of them. And thank you for your feedback. Thank you for your ideas and ones that you wanted to see. We've got marketing and all, like I said, next one.
I would like to do a deep dive onto partials as well.
Partials, yeah.
I think working with funders would be a fun one to do.
Yeah.
I think how to use your retirement account. So we've got a few in the Note Investing 101 series. So if you want to know where and when the next video is going to appear, the next one is going to be coming up. And so we will send you an email. All you have to do is go to noteinvestor.com/101. And when you put in your name and your email, it'll put you into the notification of when the next live session is. It will also give you a free download, 2 free downloads, actually. One is the 5 ways to cash in and cash flow notes, where we actually detail these deals that we had here. So you can see those in an ebook format. And then we also have 21 tips for note investing. So if you're looking to buy and sell notes yourself, those are some really great tips that we've learned over the year that I think are the best for people that are getting started out. The things you definitely, the must-haves, must do. So if you go to noteinvestor.com/101, you'll get both of those things. And we really appreciate you spending some time here with us today. We love talking about the note business, and we hope you love it as much as we do.
Yeah, and if you're not catching this live, or there's a question you want to ask, then you don't want to ask here publicly or whatever, then go to noteinvestor.com. and send us an email. There's a contact form there. Send us an email, and there's no like secret group of people answering those emails. It's her or me, and that's it. But as the little thing said, like, share,
hit the bell.
I don't know what the bell.
The bell means that they'll get notifications when we go live next time on Facebook or YouTube.
Oh, okay. All right. So I didn't know that. So hit the bell, apparently. Anyway, thank you so much. We'll talk to you soon. And
happy note investing.
Happy note investing.